Hello and welcome. With all of that's happened in the natural gas space, especially over the last few months, induction cooktops really have taken center stage, and Stovekraft therefore in focus for the last few months. We'll see whether that demand is sustaining or not, whether that's a trend which has changed or not. So that's one part of it. The other part of it is the fact that we've seen a stupendous run up on the stock price. It's one of the more expensive counters within this space. So we'll try and get a sense as to what's playing out. And whether that kind of drive is warranted. There's also some bit of capacity utilization and needs to get ramped up. There's almost 2,500 to 3,000 crore of revenue potential within the capacities that they've put up. Now, whether they can scale that up very quickly, will it take some time? How is it playing out? There's the IKEA deal as well, which they've cracked. They've incorporated a wholly owned subsidiary in China, as a result of which components will get shipped through that JV, 50-50 JV. And that too is one of those reasons why speaking with management is going to be important to kind of do. First off, this was incorporated in 1999, right? It's kitchen and home appliances and cookware in that space. Now, if I were to just give you a flavor with regard to what this does, it's tried to penetrate across the board into the kitchen, into the Indian kitchen. It's a vastly competitive market as well, and therefore those are some features which you want to look out for when we're analyzing this one. It's backed by the Gandhi family. We'll speak with Rajendra Gandhi, who's currently leading the company. Market cap of 2,400 crore is what this sits at. So that sets the context up. Now let's talk about products, cookware products, and you'll see a slew of from budget to premium, everything within the cooking space. You've got pressure cookers, non-stick cookware, hard anodized cookware, which is more premium in terms of the product, and then there's cast iron and triply cookware, for which even the JV is going to be helpful for them with China. In terms of cooking surfaces, you've got gas cooktops. Glass cooktops are nothing but gas cooktops with glass, so a slightly more premium finish. Induction cooktops, which are flameless cooking using magnetic heating. You've got built-in hobs. And you've got stainless steel cooktops as well. In terms of kitchen chimneys, this is a segment which has very low penetration in India, and therefore it's something that Stovekraft can really push. But of course, it's extremely premium as well as a product. We're not used to chimneys here in India. You've got small kitchen appliances, the likes of mixers, grinders, wet grinders, dough makers, air fryers, electric rice cookers, oven toasters, grillers, electric kettles. They're there across the board where Stovekraft is concerned. You've got home appliances, the likes of electric irons, garment steamers, electric water heaters, ceiling fans, BLDC motors, vacuum cleaners, and personal care appliances. This is also something they do outside of the kitchen, of course, as you can see. Then there's home solutions and utilities. Within that space, you've got LED bulbs, knives, choppers, flasks, water bottles, lunch boxes, and the like. You've got also home safety as a new category which they are entering into. Then they do exports as well. In exports, they do outdoor cooking grills, cast iron cookware, and then there's the IKEA partnership, which is also expected to kickstart in terms of starting to reflect on the top line numbers in FY27 in a slightly more significant fashion. You're looking at brand, and they've got three big brands. One is the Pigeon brand, which is mass market kitchen and home solutions. This is, of course, to price-sensitive customers, high volume, and they do this pan-India. Then you've got Gilma, which is a slightly more semi-premium, modular kitchen solutions and the like, chimneys, built-in hobs, glass cooktops, premium cooktops, and the like. That's built through Gilma. And then you have Black & Decker. Now, this is not their own brand, not something they've created. They've basically taken the distribution rights for the brand here in India. Kitchen and home appliances under the brand license is what they get. Steam irons, kettles, coffee makers, rice cookers, and hand blenders. That's really the segment which goes and sits under Black & Decker. Now, in terms of geography, 90% is still India. It's still domestic. 10% is exports. Revenue from India, 40% of that revenue comes from South India, so they've got a dominant presence there. The rest of India is 60%. The business model, they design and manufacture kitchen and home appliances in-house. Major raw materials are aluminium, steel, glass, plastics, electronics, all of which have gone up in price outside of electronics. 50% of the components are sourced from outside India, including China, which is why the JV to try and insulate that part of the supply chain. You've got 95% of products which are manufactured, assembled in-house now, which wasn't the case earlier. So there's a larger dependence of in-house products, which is obviously margin accretive as well for them. When you're looking at products which and how do they push it out, of course, distributors is one way. Retailers, their own stores, as well as e-commerce, they push their products through all of those channels. Supplies private label cookware to large global retailers. So that is for the private label space as well. That's something that they do. So they don't just do retail, they also do B2B. And revenue breakup is on your screen. Small appliances, the largest chunk now, 40% of the 1600 crore top line. You've got 20% from pressure cookers, 18% from non-stick cookware. Induction is around 12%. It was 15 to 16% in the quarter ended FY26, something for your reference. And gas cooktop is approximately 8%. That makes up the full 100. Presence, they've got 330 stores currently through the Pigeon brand, 22 states, 151 cities. That's the largest penetration they have in terms of brand. Now, let me talk about the financials as well. You're looking at top line growth, which has been slightly subpar, sub 10%. 8% is what the top line CAGR for the last 3 years is. You'll see that it's been slightly more slower moving in that sense. They did 10 to 11% over the last year or so. But nonetheless, the goal was to do 15. They've fallen short where FY26 is concerned to that extent. EBITDA has grown much faster at 18%. There's been some choppiness in margins, which has deflated the FY23 margin, which is why you're seeing a stronger growth on the EBITDA count. When you're looking at profit after tax, that's grown at just 5%. Of course, there's some pieces which is weighing in, which is capex, depreciation, interest costs, all of that. But nonetheless, some of that seems to be getting ironed out going into FY27. That's something you want to keep on your mind as well. Plus, the higher base of FY22 hasn't yet been fully breached. When you're looking at margins, they were at 8.5% in FY22. They've gone up towards 10.5%. So in that sense, slightly positive, but it's a highly competitive landscape. Remember, you've got the likes of a Hawkins, you've got the likes of a Butterfly Gandhimati in this similar space. And a large part of that revenue comes from such competitors, or rather the revenue comes from products which competitors also have. And therefore, you've got that weighing in on margins. And you want to keep that in mind when you're looking at the margin number. Now, let's look at the balance sheet. The book value is approximately 500 crore with a market cap of around 2300 crore. That's around 4.5 times in terms of market cap to book. When you're looking at borrowing, it's currently zero, but what we need to look at also is lease liabilities. They keep opening stores, which is Stovekraft keeps opening stores. So the lease liability stands at around 60 crore. It used to be 150 odd crore. We'll get a perspective as to what's played out on the lease liability side of things. We'll get a sense of that. When you're looking at cash bank balance, quite decent in that sense, 30 crore in terms of cash bank balance. When you're looking at cash flow conversion, there's no concern there. Working capital is one concern which has weighed down on the numbers, but outside of that, you're seeing a fairly decent conversion of EBITDA to cash flow. When you're looking at return ratios, they were traditionally far better. We've seen a sharp fall in the return ratios towards 10%. Can it boot up? Mind you, I spoke about how the potential revenue, the capex already done, is for 2500 to 3000 crore. And therefore, if at all margins were to improve with the China subsidiary, if at all top line were to go up, you could see this recover. You want to wait and watch as to how return ratios shape up. When you're looking at shareholding pattern, 56% owned by promoters, no concerns whatsoever there. One piece I want to quickly highlight, 15% to 16% of the promoter ownership is pledged. So debt is one possible concern, but 40% non-pledged promoter ownership isn't too much of a concern either. Plus debt has gone down in the company. We'll talk a little bit with the management about this as well. You've got 1% FI ownership, around 8% DI ownership, 35% owned by the public. Analyst recommendations, well, unfortunately, while there are 5 buy calls, 1 hold call, no sell calls, the return potential is negative 9%. So you've already seen a decent run up in the stock price. The target price is what keeps us slightly sanguine about this one, which is why we've given this a thumbs down. When you're looking at valuations, currently trades at around 37 times 1 year forward, Trailing 12 months is at 56 times. The 5-year average has been 26 times, and the 5-year range is 14 to 45 times. But mind you, a bulk of that margin and ROC is behind us. Capacity has already come on stream. We need to see whether that can convert to revenue. And therefore, you want to keep an eye out on whether this P changes substantially over the next couple of years. But the 1 year forward clearly indicating a downtick or a compression in the price to earnings ratio from that 55 times to 37 times, which is a meaningful compression in a year. When you're looking at the trailing 12-month Ps compared to some of the other players, Hawkins trades at approximately 31 times, TTK Prestige at 42, Butterfly at 25, and Stovekraft, therefore, trades at a slight bit of premium versus all of those. And therefore, even on a 1 year forward basis, this is all trailing 12 months, even on a 1 year forward basis, it trades at a premium. So just to kind of set this up, now let me bring on board Mr. Rajendra Gandhi, who is part of the promoter group here at Stovekraft. Great having you here, Mr. Gandhi. Let me first start off by understanding, with regard to induction cooktops, has the kind of demand that you saw Q4 as well as early Q1 FY27, have those trends continued to sustain, or have we seen an ebb off with regard to that trend?
Yeah, good afternoon. Thank you. Regarding the induction cooktop, we would want to highlight that we are experiencing continuous growth. We have seen that huge spike in the month of March, but then we are seeing adaptation of this appliance. Now this has become centered to every kitchen. There is a change in cooking habits, moving from LPG stove to induction also. Induction is there to be used by either as a backup device or by students and bachelors. But today it has become center, it is getting into the main cooking arena in the kitchen. So with this, we are seeing continuous growth in demand. So that the demand continues.
Okay. And therefore, this 15 to around 20% kind of mix of revenue coming from induction cooktops, is that something which you sustainably expect even in FY27? Also, is induction cooktop slightly better in terms of the EBITDA margin? Gross margin likely better, but EBITDA margin as well, does it fetch you a better margin?
Yeah, margins are good. We are agnostic to margins, but this product being in high demand now, our margins are better than normal on the induction cooktops. And on the contribution to revenue, we believe this could move from that last year's 25% base to 12% base to 25% contribution to the revenue to this to the company this year. We are likely to grow at least upward 100% on revenue on the induction cooktop.
Wow, that's extremely strong. 100% revenue growth, which in itself implies maybe 12 to 13% growth for full year FY27 coming only from induction cooktops. Is that the right way to think of this?
Yeah, the demand continues to be very strong, and we are fully geared up to address this demand. We are also further enhancing our capacities. With the current, also we are seeing very good growth with the capacities that are already in place.
The China JV which you've entered, what does that give you in terms of a leg up from a supply chain standpoint, one, and from a margin standpoint? Give us some color on that.
There are two new entities coming up. One is a wholly owned subsidiary, 100% wholly owned subsidiary in China. So we want to consolidate all our buying from there. We have substantial buying from China in various components and the inputs in our manufacturing. So that will give us a little more advantage. There are some duty drawbacks. That advantage remains in China. And there is a step-down subsidiary under the wholly owned subsidiary where we have a JV to manufacture tri-ply stainless steel coils and circles, which go into the manufacture of our pressure cookers and cookware. Both these will augment both our margins and our supply chain.
And how much of the cost is linked to raw materials coming from China at this point? I believe around 50% is linked to raw materials coming straight from China. Your gross margins are maybe sub 40%. So can I say that 30% of the cost of goods sold is coming straight from China?
Perfect. I think the math is perfect.
Okay.
50% of our inputs are imported, and then most of this is coming from China. And material cost is in the range of 60%. So 50% of that is 30%.
Okay, so how much does this add to the gross margins for you? Pretty much immediately? Does it take some time? How does it work out?
It's a gradual process, but
Okay.
definitely in the years ahead, we will have complete control on our supply chain and cost.
So could you give us maybe over two timelines what the benefits will be and how would they accrue? Maybe FY27, how quickly do the benefits accrue to gross margins? And maybe FY29 over the slightly longer period, how much margin accretion happens as a result of this only China?
FY27, not much. You will not be able to see any because it's a
Okay.
meaningful contribution. But by FY29, between 3 to 4, total of our revenue, between 3 to 4% is what a possibility is there with this kind of arrangement. We are going to have one more middle layer chopped off, our own company buying and exporting it to this company in India. So definitely there is an advantage. Being 50%, we see 6-7% arbitrage there. So 2 to 3% is definitely a possibility in the next 3 years.
Very interesting. Okay, you've guided for, I think you had guided for 15% growth FY26. What's the FY27 growth guidance, given the kind of growth that you're looking for within the induction cooktop space?
We did miss on the FY26 numbers, but we are confident of a better growth rate than the 15%. While we have been guiding you at 15% growth, but we are confident of doing much better growth this year than the 15% base.
Okay, talk to us about how many stores you plan to open, because that's one of the drivers of growth for you. You did, I believe, 30 plus stores in the last quarter itself of last year, which is strong. Give us a sense as to how this plays. Oh, I believe you did 16% growth on the last quarter, but that's still 15 around a 5 to 6% growth of the total stores that you have. So how does that play out? Give us a sense. FY27.
FY27, I mean, annually we will be at a run rate of 100 stores. So every quarter it will be around the 25. It could be plus and minus on that, but annually we'll be able to grow at 100 stores annually.
Then what's keeping you sanguine, Mr. Gandhi, with regard to putting out a stronger top-line guidance? Because if you're going to do 12 to 13% only from induction cooktops, and then if you're going deeper and adding another 100 stores, which is 30% of your current store count, then that should give you very strong growth tailwind.
There are multiple levers of growth. We are very confident of very good growth every quarter. I mean, we believe that we'll be able to witness that growth. And I just mentioned that we'll grow at much higher than 15%. But since we had a disappointment with the investing world last year, we would want them to experience the growth. Every quarter, we are seeing very good growth. So every quarter, there will be good growth. It will definitely be much higher than the 15%.
Okay. Could you define much higher? Will it be 25? Will it be 30?
Could be in the range between 15 and 25.
Okay. Okay, between 15 and 25. You've got a capacity to do maybe 2,500 crore to 3,000 crore of top line. You've put out 3 new lines, which puts out maybe 200 to 250 crore in terms of top line right off the bat. I'm trying to bridge this gap between 1,600 to 2,000, because that will take you to the 25% growth. Firstly, how quickly does the 250 crore, the 3 new lines, add to revenue, and how quickly does that translate to revenue?
For the revenue for this year, we are fully equipped, we are fully capitalized, and even for the forthcoming year, we are fully capitalized. As you rightly pointed out, even for a 2,500 crore, we would not require any more capex, but the growth is accelerating. It is faster than we envisaged for the. So what we believe is that we'll be able to do the growth what we were otherwise wanting to do in 4 years and 3 years. So FY29, we'll exhaust all this capacity. We'll have to start working on additional capacity next year. So currently, whatever is capital, I mean, we have, the capital investment into our manufacturing is good enough for existing growth to get to 2,500.
Okay, and from IKEA, what will the top line component be? You guided 50 crore, if I'm not wrong.
For this year, yes.
Yes, for FY27, that's correct. But how does it ramp up? Give us some color on that.
We believe the capacity that we have built for IKEA will take us between 200 to 300 crores in the next 3 years. We have a lineup of products which already mutually agreed, but there is a process of introducing these products. They are very, very process driven. Generally, from the time we finalize to get down to developing a product to actual supplying, it takes 1 year. So we have 3 lines in the pipeline. The first line will start billing, invoicing from this end of this quarter, early next quarter. From the end of this quarter, we should start seeing revenue from IKEA.
Okay, and raw material prices, how is that weighing down on your margins and on your costs? How quickly can you pass that through? One, for your B2B business, IKEA and the like, and second, for your B2C business. Give us some color on that.
Yeah, the challenge in the B2B business is margins are very thin, and by the time, if there is a very disproportionate increase in the price, and by the time that is accepted, it is a little while. All our export orders are now corrected starting this month, so we have no challenge on the margin as per se on the B2B. But on B2C, we did price correction the beginning of the quarter, but we saw a continuous increase in the input cost. So we envisage one more small increase in the coming quarter, beginning of next quarter.
Excellent. And how is competition responding to this? Have they also hiked prices? Are you better placed? Are you worse placed? How does this play out?
No, it's inevitable for anybody. There was a very, very disproportionate input cost increase. We have no choice but to pass on. I am sure every company has to do that. It is not viable to continue selling at the base at what we are selling, because the input cost increase is relatively very high.
B2B versus B2C, if you can give us some color on one, your margins, what are they? You said B2B margins are quite thin. If you can give us some perspective, because 10% of your revenue, maybe FY28 or FY29, will likely be B2B, which is IKEA, which is the fresh revenue coming in. So give us some color on margins, how that shapes up. And also, if you can tell us, are the return ratios, in the sense working capital requirements are higher, likely in B2B, which means ROC is lower?
No. Let me guide you through this. When I said lower margins, of course, the gross margins are much lower than the B2C margins, but then we do not have other costs. So that's what I meant. But then at EBITDA, we are both our B2B and B2C business are at the same level. Currently, our B2B business is in the range of 12%, contributing to the total revenue of the company. And we believe this will definitely grow while the company is also growing. It will be in the range of 15 to 18% in the next 3 years. The export business is growing faster. Our domestic business is also growing faster now. So that's why the range between 15 to 18%, it could be likely 15%. But at the EBITDA margins, both are same for us. ROC also remains the similar number. Since we have recently, in the last 3-4 years, continuously invested on the various capex requirement, both at the front end and back end, the RSC looks subdued, but in the next 2 years, this will come back to the original levels that we were on ROC. But particularly on both our domestic brand business and the export, our ROC levels are the same.
Okay. And Mr. Gandhi, last question with regard to the 100 new stores that you're going to increase the store count by. How much of capex will that require? What happens to debt? And there is some promoter pledge, which could also be a concern for investors. What happens next with regard to that? Could you give us some color?
On the retail, I would want to guide you that there is no capital infusion from the company. The way it is structured, while these are company-owned and franchisee-operated stores, are fully funded by the deposits that we take from the franchisee. So there is no additional cash flow from the balance sheet of the company. The retail expansion actually requires no additional cash. Can you pardon me with the other two questions?
On the promoter pledge, Mr. Gandhi, if you can give us some color on how that unwinds.
There was an opportunity when Sequoia was exiting. I had leveraged this buyout, and we would want to release this pledge in the next 6 to 8 months. Within the next 2-3 quarters before end of this year, this pledge will be completely released.
Excellent. Thank you so much, Mr. Gandhi. I know I haven't taken a margin guidance from you. If you can give us that number for FY27 and beyond very quickly.
We'll grow by 1% at least, and the steady
Okay.
state by the end of these 3 years, we should be in the range of 14-15%.
Okay. Thank you so much, Mr. Gandhi. This has been excellent. I mean, we've covered plenty of ground, viewers, as you would appreciate. Completely thank you on this edition of AAYC. Thank you so much for joining.